There's a strange moment that happens to people when they first make money in the stock market. Not a little money, real money. The kind that changes how they walk into restaurants, how they speak during conversations, how they suddenly start believing they understand the world better than everyone else. And that's the dangerous part. Because Wall Street has never just been about money, it's about ego, perception, status, fear. The desperate human need to feel smarter than the crowd. And every few years, the crowd loses its mind. A company with no profits becomes the future. A dying business becomes undervalued. A billionaire says one sentence on television, and millions of people rearrange their lives around it. Not because they understand the market, but because human beings are emotional creatures pretending to be rational. And maybe that's why so many people fail. Not because investing is impossible, but because the stock market is one of the few places on earth where your intelligence matters less than your emotional control, where patience looks like stupidity, where confidence can quietly become delusion, and where ordinary people paying attention to the real world around them, sometimes outperform the experts who spend their entire lives staring at screens. That was the uncomfortable idea at the center of beating the street. Not that investing is easy, but that most people are looking in the wrong direction. Because while Wall Street was obsessing over complexity, the truth was hiding in plain sight. There's something strangely theatrical about financial television. The expensive suits, the fast talking analysts, the giant screens glowing with red and green numbers like a military control room preparing for war. Everything about it is designed to create one feeling. These people know something you don't, and maybe sometimes they do. But markets have a brutal way of humiliating certainty. The same experts who confidently predict recessions suddenly become optimists during crashes. The same people who scream buy at the top quietly disappear near the bottom. Because most forecasting isn't prediction, it's performance, and deep down, people don't actually want truth from experts. They want emotional reassurance. They want someone to make uncertainty feel controllable. That's why investors cling to forecasts, even though forecasts fail constantly. Human beings hate ambiguity. We would rather believe a confident lie than sit inside uncertainty. And Wall Street understands this perfectly. But Peter Lynch saw something different. He noticed that ordinary people often encountered reality before analysts did. A nurse notices a medical product everyone suddenly depends on. A parent sees which toy children become obsessed with. A teenager knows which store is always packed before earnings reports ever mention it. Reality happens on streets, not spreadsheets. And that idea sounds simple until you realize how deeply it threatens the entire culture of financial superiority. Because if ordinary observation matters, then expertise loses some of its mystique, and institutions hate losing mystique. Imagine walking into a crowded restaurant. There's one empty table near the entrance, but everyone keeps walking deeper inside, waiting for tables near the back. Immediately, your brain starts assuming something. The better tables must be back there, even if nobody actually told you that. That's social proof. One of the strongest psychological forces on earth. Human beings survive by copying groups, and markets weaponize this instinct constantly. When prices rise, people assume value exists. When prices fall, people assume danger exists. But price and truth are not always connected. Sometimes a stock rises simply because other people are buying it, and people buy it because it's rising. An emotional loop, a psychological stampede. That's why bubbles feel so convincing while they are happening. Not because everyone becomes stupid, but because social validation is intoxicating, especially when money is involved, especially when people around you seem to be getting rich effortlessly. You see neighbors making fortunes, friends suddenly talking about easy money, co-workers acting like financial geniuses because they bought one stock during a bull market. And slowly, the fear changes. People think fear means losing money, but during bubbles, the real fear becomes missing out. That fear destroys discipline faster than greed ever could. Because greed still calculates. FOMO doesn't. FOMO panics. It rushes. It abandons logic just to avoid social pain. And that's how intelligent people end up buying nonsense at absurd prices. Not because they analyze incorrectly, but because emotionally they couldn't tolerate being left behind. Most people think investing is about finance. It isn't. Finance is just the surface layer. Underneath it, the market behaves more like mass psychology, a giant emotional machine reacting to stories. Optimism creates buying, fear creates selling, narratives become reality, and the stories matter more than people realize. Because human beings don't make decisions based purely on facts. We make decisions based on meaning. A company isn't just a company anymore. It becomes the future, or the comeback story, or the safe bet. People become emotionally attached to narratives because narratives reduce uncertainty, and uncertainty exhausts the human brain. That's why markets swing violently between extremes: euphoria, panic, hope, despair. The facts often change far slower than emotions do, but emotions move prices immediately. This is why some investors become obsessed with predicting human behavior rather than predicting economics. Because markets often overreact long before reality catches up. A small disappointment becomes catastrophe. A small success becomes salvation. And somewhere inside all that emotional noise, opportunity quietly exists. But opportunity rarely feels comfortable. That's the paradox. The best investments often feel emotionally difficult at first. They feel unpopular, uncertain, even embarrassing. Because if something already feels safe to everyone, the price usually reflects that safety. The crowd pays premiums for emotional comfort and discounts uncertainty aggressively, which means the investor's real battle isn't intelligence, it's emotional independence. There's a specific kind of arrogance money creates. Not immediately. At first, people are cautious, humble, careful. But after a few successful investments, something shifts. Success starts rewriting memory. People stop attributing gains to timing or luck. They begin seeing themselves as uniquely insightful, and ego quietly enters the room. The terrifying thing about ego is that it disguises itself as conviction. A person stops asking, "What if I'm wrong?" and starts asking, "How can everyone else not see this?" That transition destroys people because markets punish emotional attachment. The moment an investment becomes part of your identity, you lose objectivity. Now you're defending yourself instead of analyzing reality. And this happens everywhere. People hold collapsing stocks because selling feels like admitting failure. Executives lie to themselves because truth threatens status. Analysts double down on bad predictions because public embarrassment feels unbearable. Human beings are astonishingly creative when protecting their egos, even against reality itself. That's why humility becomes a competitive advantage, not fake humility, real humility. The ability to change your mind before reality forces you to. The ability to say, "I was wrong." Most people would rather lose money than lose ego, and markets know it. One of the most radical ideas in beating the street was almost embarrassingly simple. Pay attention. That's it. Not complicated formulas, not secret algorithms. Attention. Because ordinary life leaves clues everywhere. A crowded parking lot, a product constantly sold out, a store expanding faster than competitors. Small observations, tiny signals. Most people ignore them because they seem too simple to matter. But simplicity often hides truth. Meanwhile, institutions drown in complexity. They build models so intricate they lose contact with reality itself. There's something deeply human about this tendency. People often trust complexity more than clarity. A complicated explanation sounds intelligent. A simple explanation sounds suspicious. But reality doesn't care about sounding impressive. Reality only cares about being true. And some of the greatest investors in history understood something uncomfortable. You do not need to know everything. You just need to notice what others dismiss. That idea democratizes investing in a way Wall Street dislikes. Because it means awareness can outperform status, curiosity can outperform credentials, and patience can outperform brilliance. But ordinary observation only works if you combine it with discipline. Otherwise, people simply fall in love with brands they personally enjoy. And personal enjoyment is not analysis. That distinction matters. A great product doesn't automatically mean a great investment because perception can inflate prices far beyond reality. Again, human psychology enters the story. Always. Every financial era creates its own mythology, its own language, its own emotional spell. One decade worships internet companies, another worships real estate, another worships artificial intelligence. And during these periods, something dangerous happens. People stop asking practical questions. How much profit does this company make? Can this business survive hard times? Does the valuation make any sense? Those questions start sounding old fashioned, negative, unsophisticated. Because hype changes social incentives. Skepticism becomes socially uncomfortable. Doubt feels emotionally isolating. And suddenly everyone starts repeating the same phrases. This changes everything. The future is different now. You just don't get it. Those words have destroyed fortunes for generations. Not because innovation is fake, but because human excitement always outruns reality. Always. And companies understand this. Executives know storytelling affects stock prices. Media companies know excitement drives attention. Influencers know certainty creates followers. So the system rewards emotional stimulation, not balanced thinking. The louder the story, the more attention it receives, and attention itself starts becoming value. That's why bubbles often feel almost religious. People aren't just investing money, they're investing identity, belonging, hope, meaning, which is why criticism feels personal. And when reality finally arrives, the emotional collapse becomes brutal, not just financially, psychologically, because people aren't merely losing investments, they're losing the story they emotionally lived inside. The market reveals something terrifying about human nature. Most people say they want wealth, but emotionally, many people are not built for uncertainty, and wealth requires uncertainty. You cannot demand safety and extraordinary returns simultaneously. At some point, you must tolerate discomfort, temporary losses, ambiguity, public disagreement. Fear changes perception. During crashes, strong companies suddenly look doomed. Optimism disappears from the world almost overnight, and people become desperate for certainty. That's when headlines grow darkest. That's when panic spreads fastest. And ironically, that's often when opportunities become largest. But psychologically, buying during fear feels unnatural. Everything in the human nervous system screams against it. Because evolution trained us to run with crowds during danger. not stand still while everyone else panics. This is why emotional discipline matters more than raw intelligence. A genius with no emotional control becomes dangerous, especially to himself. Meanwhile, a calm investor with average intelligence can outperform simply by avoiding emotional self destruction. And that sounds almost disappointing. People want investing to be complicated, they want hidden secrets. But often success comes down to avoiding catastrophic emotional mistakes repeatedly over time. Patience, discipline, perspective, boring words, until you realize how rare they actually are. Modern culture trains people to expect immediate results, instant entertainment, instant validation, instant wealth, and the stock market exploits this impatience constantly. People jump between trends searching for rapid transformation, but compounding is emotionally unspectacular. That's why so few people truly commit to it. Real wealth often grows quietly, slowly, almost invisibly at first, and human beings struggle to respect slow progress. We worship dramatic success stories because they create emotional excitement, but sustainable investing is often deeply uncinematic in real time. Long periods of boredom, doubt, waiting, and waiting exposes psychology because silence forces people to confront themselves. Without constant stimulation, insecurities surface. What if I'm wasting time? What if everyone else is getting ahead? What if I chose wrong? The market becomes a mirror reflecting emotional weaknesses back at people. Impatience, ego, fear, addiction to excitement, need for social validation, all exposed, which is why investing eventually becomes philosophical. You begin realizing the greatest battle isn't against the market, it's against your own impulses, your own emotional volatility, your own hunger for certainty. And maybe that's why the best investors often appear emotionally detached, not because they lack emotion, but because they learned emotion cannot drive decision making. Most people misunderstand the phrase. They think beating the street means defeating other investors, outsmarting institutions, winning some financial competition. But the deeper meaning feels far more psychological because the real street isn't Wall Street, it's collective human behavior, the emotional chaos, the manipulation, the social pressure, the fear driven decision making, the endless noise demanding your attention every second. To beat the street, you first have to stop being psychologically controlled by it. And that's difficult because modern financial culture constantly tries to hijack emotion. Urgency, excitement, outrage, panic. Everything becomes amplified because emotional people click more, trade more, react more. Calm people are economically useless to media systems. So the environment rewards emotional instability, which means emotional stability itself becomes an edge, a rare one. The investor who can stay rational while others become euphoric, the investor who can stay patient while others panic, the investor who can admit mistakes quickly without ego collapsing. That person already operates differently from the crowd, and over long periods of time, difference compounds. In the end, beating the street was never really just about stocks. It was about attention, human behavior, emotional control, the ability to observe reality without becoming hypnotized by collective emotion, because markets don't merely transfer money, they expose character. They reveal who panics under pressure, who follows crowds blindly, who confuses confidence with wisdom, who needs validation more than truth. And maybe that's why investing becomes strangely personal over time. Because eventually you realize every financial decision contains a psychological confession. What do you fear? What do you believe? How much uncertainty can you tolerate? How badly do you need approval? The market asks those questions constantly, silently, relentlessly, and most people never realize they're answering them. That's why ordinary observers sometimes outperform experts, not because they know more, but because they see more clearly, without the performance, without the institutional ego, without the need to appear brilliant. Just attention, patience, reality, and maybe that's the uncomfortable lesson buried underneath all of this. The people who consistently win are often not the loudest, not the most dramatic, not the most confident. They're usually the people capable of doing something emotionally rare in a world addicted to noise. Thinking independently, even when it feels lonely, even when it feels boring, even when the crowd laughs at them, because in markets, as in life, the crowd often mistakes emotional intensity for truth. And by the time everyone finally agrees something is obvious, the opportunity is usually already gone. Fade out, soft ambient music, city lights reflected across trading screens. Ordinary people walking through grocery stores, malls, neighborhoods, carrying invisible clues about the future without even realizing it. The market was never just numbers, it was human nature with a price tag attached.